Good morning, guys. So that's 25,808 in the Nifty, and we have Bank Nifty also, which is trading well at 60350. Wednesday morning, first day of the new series of the 10th of Feb, and we started off February with a lot of volatility, right? That's volatility with a capital V, market which has gone down, up, and two different events not completely factored in by the markets have hit us as option traders, and that's why we are seeing the market doing what it is doing right now. So first and foremost, guys, it's been very, very volatile, and if you've taken some bad trades, do not punish yourselves too much for it, because what we've been witness to in the past 3 days is something very, very anticlimactic, in the sense it's an event which does not happen that often. And if you've taken some bad trades, that's because the market has been caught completely by surprise, and the market did not see that news in the budget of the STT increase. Who in their right minds would do that in a market which is not growing for the past 2 years, 3 years? The market did not see that rise coming, the STT move coming. It was completely taken back. And the other news about the news, okay, about Trump and that trade deal, that the market has been expecting from August, September. But right in the middle of that budget thing and all that STT events, for that to happen the very next day, that was again an exogenous event which was not factored in by the markets. And every time an event happens which is not factored in, which is not priced in by the market, that's the time the market reacts or tends to react a bit differently. So you saw that yesterday at the open, there was a run on call writers, on people who had futures shorts open, and they may not have been put over there for profit. They may have been put over there to, protect or prevent the portfolio from making big losses because of that budget event. So those guys took a hit in the opening minute yesterday, and I made it a point to look at that volume carefully after I came in yesterday, and that volume was 45,000 contracts in the very first minute. So that's the kind of trading impact that decision had. Completely unexpected, completely caught the market by surprise, and the market was short futures, mostly portfolio holders, mostly portfolio guys and big institutions, to protect the account from downsides. They were the ones who took the hit yesterday, and there wasn't a lot of long in the market, as we saw through the COT data and the order flow data. Nobody had positioned to benefit from a big upside in the market. So all the positioning which was there to protect the portfolio, to prevent the account from going into further losses because of that anticlimactic budget event, all that took a hit. So a lot of people have been bleeding in the past 2 days. The point over here is it's something which the market does once in a while. It does not do it all the time. And if you've taken a hit, shrug it. Do not punish yourself too hard for it, because it's one of the things which happen in a market at all times. But the learning still remains, and some of you had asked me the question, how do you respond to an event like this, which may happen in the future? And I'll be honest with you, it may happen in the future again. The best response to it is take it as a teaching lesson, where you honor the risk in the market, you honor your position sizing, you do not go excessive greedy, looking for a quick downside or a quick upside, go beyond your normal trading limits, beyond your normal trading appetite, and take outsized positions in the market. Those are the kind of traders who took a hit yesterday. But the traders who were just hedging and who were managing exposure, they know that they take these kind of hits once in a while. So all that is fine. It's part of the ways in which a market works. But if you are careful about the kind of risk you deploy and the kind of capital you bring to the market, and how you have to position size around that capital, well, it's not something big, okay, which happened. It's something which may happen again, but as long as you take the proper lesson from it, it should be fine. So on that note, I just want to quickly, okay, take you to where it is, because now that these two big events the market was expecting in 2026, they are gone. It makes sense to have a look at where the market is positioned in terms of the expected movement into the rest of 2026. So I prefer the top-down approach, and every time the market is complex, it is volatile, it's moving in a big fat range, it always makes sense for me to take the focus out of the mini and focus on the big picture, the macro picture of the market. And the macro picture is always the yearly time frame and the monthly time frame. And here we have 2027, which is begun, which has gone up to the VAH, the value area high, has not shown us demand at the value area high yesterday on that test. And a market which we knew was going to test the VWAP of 2026, it did that on budget day, and it's bounced from there. So these levels were there before the news came in. What we have to do is to see if the market responds or reacts at these levels. The levels were there before the news. Let me underline that. The levels were there before the news. The market responds to those levels. It reacts at those levels. Now, if you're one of those traders who works with random levels in the market and you think everything is a great level and you operate out of every single level in the market, then you're confused in the market. You don't have a system or a strategy in place. The reason we work with market profile is to identify and take out all the noise from the market and look at big areas where we get massive signalings, like VWAPs of the year, like value areas of the year, like POCs of the year. Those are sacrosanct levels the market respects and trades in every day. And not just on the annual time frame, it works on the monthly time frame, it works on the weekly and the dailies also. But here again, we are seeing that the bounce is off the VWAP, which is around that 24,700 spot zone. This is a spot chart. And going into 2026, this is a spot chart. This is 24,700 VWAP of the move up of 2025. And going into the rest of 2026, all we'll be looking for is whether we see signs of supply coming back at 24,700. We spoke about this 1 week before the budget also, and on budget date we bounced from that VWAP, which is something which you should not miss when you're looking at this particular structure. I'll quickly come down to the monthly profile, and the monthly profile has gone back and tested the highs of the 3 months. And yesterday in that order flow data, you can pull up your Nifty futures. You can see that in the order flow data, as we tested the highs, it was a short covering run which forced us to go back to these highs. There was no new demand added at the highs for the market to make a serious attempt to go above value area high. So we keep saying this all the time: above value area high, look for evidence of more demand or evidence of more buyers in the market. Did we see any kind of buyers in the market yesterday? Absolutely not. In fact, okay, in the order flow chart of yesterday, on a gap up, we should be wanting to see IB3s. And there was no IB3 in the market yesterday. So this was the third, 9:15 a.m. So on this gap up, we should have seen a lot of IB3s come up. And I'll go back, okay, to that first 1 minute of trade. So that volume was 45,000 contracts yesterday. 45,000 contracts in the very first minute. And where have you seen this kind of volume in the very first minute any time in the past? So this is a market which was caught completely off by surprise, and all this green caught is actually short covering which is there in the market. But the market had a chance to put in new demand in that first 30-40 minutes, except for this one IB3 over here, which was 25,932 and did not activate. We have not seen any IB3 on the gap up. which is why we are down to about 25,822 now, and a market which is now wanting to go back and test that gap zone which we spoke about earlier. So this is the bigger picture. This is the bigger picture of the market. This A period tail is around 25,960, which is a responsive selling tail from yesterday. To counter that, we have two tails today. So that's why, okay, I'm looking to see if this market goes back below 25 or 780 today, 780, 800. Felt okay that 25,800 was an inflection point, but we will not seen a lot of demand out over there. I'll come to that order flow chart and talk you through that trade, which I'm still wanting to hold, the long put trade. We'll walk you through that. But for the moment, what I want to see in the market profile chart is a move by supply into the singles of morning and the singles of yesterday, and an activation of that IS30 initiative selling tail. So the supply is not as big as it has been in the month of January, and it's to be understood against what happened yesterday. So that short covering run was major on call writers, on short futures. So you would expect the very next day that, in fact, all through the session yesterday, that supply was on the back foot. Supply had backed off. So it may be about a session or two before we see some aggressive supply of the kind we've seen all of January again back in the tape. So the context to that is that supply took a hit yesterday, and a very big hit yesterday, and they would think two times before adding fresh supply in the market. Does that mean that this market is long at the moment? Absolutely not. And the best way to understand that is to again look at an order flow chart, and I'll go with that 30-minute time frame, and I'm seeing an IS30 at 25,882 activated. It went to 25,788 today, and this morning it dipped lower. On that dip, I saw this 527 responsive buyer, and these zeros early in the morning. 4th of February, these zeros early in the morning, right here at 527, told me, okay, that there wasn't a lot of demand, to a lot of supply to push the market down straight at the open at 9:15 a.m. And IB3 came in along with an RB3, and once this IB3 was active and the NTM Molex was blue over purple, blue over pink, that was the reason we got ourselves into that long trade. Now, when that long trade was happening, the stop loss was 25,800, and the market went back and tested that 25,800. It always tests a demand zone if it is not there. But after that test, you expect the market to show you some more initiative buying or a lot more green. Because the purpose of a test is always a test of the market to see if it can add demand. And when I saw that the RS was there and IS was there, and the COT on the test after the test was not showing any kind of green, that was a reason for us to get out of that call trade. Again, the whole idea over here is that we do not leave anything to chance. We follow a working process. We allow the data to speak to us. So there I saw, okay, one comment come in that the trade stop loss was respected. That's not our job to respect or not to respect our stop loss. We put a process to work in the market. There is a certain logic and a methodology we adopt for that particular trade in which we are in. The market can give us a win. The market can take our stop loss. It's not our job to tell the market what to do. But as long as our process is right, as long as we are working with a proper system and a logic in place, it does not matter what the market does. We will not expect every single trade of ours to win all the time. But what we can expect is from ourselves is that we work with a proper, valid working process which can help us through all kinds of trades. So that process told us that there was no more demand adding at 25,866. And IS3 came, a second IS3 came, a third IS3 came. Now, three IS3s along with a previous IS30 tells you, okay, that demand is again out of the market, or at least the morning demand, that morning IB3 is off the market. and because it's off the market, we have gotten ourselves into a put out over there, put out over here. So that's 25,800. The market is still around over here. What I'm wanting to see is the market show me a lot more initiative supply right around over here. So this is that zone where that morning buyer is 25,800, and this A period POC is right here at 25,780. If we see some initiative supply below 25,780, I want to double in on that put, because I feel that with this morning demand gone, this should break these lows of 25,700. And what I'm eyeing for is a move into that gap of Monday, Tuesday, the Tuesday open, which is around this 25 530 odd zone. So wanting to take this a step at a time, but for now, let's see. Okay, if this goes back to these levels of 25,610 to begin with, and then this gap fill at 25,530, which is the expected place to see if demand comes back into the market somewhere around this 25,530 zone. Having said that, the market is now neutral in the sense the aggressive buyer and the aggressive seller is not there in the market, and we can think of the market in terms of working on a neutral slate for the next expiry, which is the 10th of February. So the 3rd February settlement is done. We have to start thinking in terms of the 4th of February. And for the 4th of February, the market is now thinking about 25,750 as the density zone. And the ranges are being set at 25,500 on the lower side, 26,000 on the higher side. So that's a 500-point range the market is wanting to be in for the expiry dated the 10th of February, the coming Tuesday settlement. So this is the density picture. This is the density picture of the market, and this is a projection of a market now baking in all the bad news and the good news. So you look at it as a derivatives trader, and you look at that the STT impact as being short-term negative for the market, but the US deal is short-term positive for the market. So those two events have cancelled out each other. So there was a big bull case made yesterday about the market doing new all-time highs, but I saw it as a cancellation of a very, very negative event for the market. So just look at everything as an overall picture of the market. Do not be misled by one or two scenarios which are at best a reflection of very, very short-term inventory in the market, and definitely not really a professional approach to understand and view the markets as such. Right, so we are back here, guys, and this is the big idea right now. You would want to keep a short as long as these A period singles are open at 25,950, and you would want a test of this 25,530 gap zone to happen on the belief that the A period singles of yesterday would hold. So that is your proper stop loss. But for a shorter time frame trader, you can keep it at 25,880, which is the IS30 supply of the market from yesterday, valid for 10 bars, which would be up to about 3 p.m. today. So that's the Nifty futures. A couple of questions had come in about how to look at the IV charts, etc. So I go to this OIVIS column, which is the open interest visualization. We given it a small thing, OIVIS, and it's important to understand the options market as a different beast. So there is not one thing which decides the price of an option. An options price is about an options price is about delta, it's about the gamma component, it's about IV. There are different factors which go into the making of the option premium or the option price which is there. One of the things I look at is the IV, and the reason reason we look at IV is because it inflates premiums or prices of puts. And all through last week before the budget, you saw an option which was 300, 350 for even 100 rupees in the money. And that's only because IVs were high. How do you know IVs are high compared? You always use it as a relative term. You compare it to the previous day. So what I'm doing over here is I'm choosing the date on my right hand side of the 3rd of Feb, and it's about 11 o'clock right now. So I'll go back to 11 o'clock yesterday, and I'll do an IV split over here at 11 o'clock. So at 11, the IVs had started dropping down, but it's about 18.78 and 17 in the CE yesterday, and today it's about 16 and 15. So you would say it's only a math of 3 or 4 points, but in the option world, that is actually a 20% difference. So that 20% difference is your premium, let's say of 300 on yesterday. A 20% reduction of 300 would make it immediately 240 rupees today. So that is the math which is at work in the options market. So 60 rupees is a very, very big factor over 24 hours. And that's why writers tend to make a lot of money, because they understand these little terms called IV impact yesterday, IV impact, etc. So this is what has happened. Around 10 o'clock in the morning, it was around 20 yesterday, and right at the open this was around 20 to 9:30 in the morning. This is the new series of 10th of Feb. I'm not comparing it to the 3rd of Feb settlement of yesterday. I'm comparing it to the 10th of Feb settlement, and you can see that these are higher compared to these are different compared to the ones which were on the 3rd of February yesterday. So keep this always around an event, and you would know immediately how much the IV is changing, etc., etc. So I hope this aspect is clear. Plot type IV, do it a split, and you would immediately know where these are. Currently it's at about 15 and 14, and they've been steadily dropping from 17, 18 in the morning. So Soumya is asking a very good question. How does call IV and put IV get affected if market rises, falls? So as a rule of thumb, the IVs only rise when the market falls. They don't rise that much when the market rises. And the reason for that is when the market drops, a lot of big portfolio guys, the institutions, the FIs, the FPIs, they want to buy hedges for their portfolios. So understand one thing, guys, the derivative market is not just a market for us to do directional trades and to capitalize in terms of a long call and a long put. But the major reason the derivatives markets are the markets they are is because a lot of big institutions use it to hedge their exposure. So nobody buys something like SBI stock or a Reliance stock worth 300 crore rupees without a put protection for something like something going wrong, like something which happened yesterday. So they know that things can go wrong at any point in time, and that's why a lot of people would use the options market to buy puts, to short calls, and to protect themselves in case the market decides to go down for some reason. And over a period of about 20 or 30 years, you will see that the markets go down faster than they go up. So what happened yesterday was an event which generally does not happen. Between the put writers and the call writers are considered to be safer in the market. It's the put writers who are always taking the higher risk. That's because the market drops a lot more faster than it rises. So you would say the market would typically take about say 500 days to rise up 2000 points, but it can go down 2000 points in the space of about 10 or even 20 days also. So they tend to drop faster than they rise. That is why puts are more in demand than calls, and people tend to buy long puts more than the long puts. So you see that in the IV currently at 15.47, on the threat of anything bad happening is gone from the market. and the market is not pricing a big downside in terms of the IVs currently. That can change. If price goes down 200 points from here, people will suddenly go and buy a lot more puts. And because people suddenly go and buy a lot more puts, you would see put IVs going up because the demand for puts has increased. So it's not just a reflection of premium, it's also a reflection of whether there is more demand coming in the option or there is no demand coming into the option. So I hope, okay, that part is clear. It's a very, very important and an interesting study, the entire IV study. And I hope, okay, you take the time to understand it, because as a derivatives trader, it is important for you to understand what is happening in that market. How do you use it for trade? You don't use IV for trade. You use IV as a supporting stance to see what the market is thinking at any point in time. So what do you do for trade? You use your market profile and an order flow, guys. It's been simplified and projected in front of you. You do not need to understand the finer prints about the budget. You do not need to understand the finer prints about the trade deal which was struck. You do not need to know how much is everything else impacting what happened in Europe, what happened in Asia, what happened in Japan. There are smart people who already have figured all of that. Our job as traders is to follow the smart money. And how do you follow smart money? You will see that in the volume which is there on screen. You will see that in the IB prints, the IS prints, the zeros, the stacked supply, the stacked demand. So everything is already there for you. Do not get conflicted with all the rest of the things which are there. Keep your focus to understanding volume, understanding price, give importance to structure, give importance to positioning, and every single thing which is required for you to trade is already over there and should help you as you go about trading. So I'll come back, okay, to this put and what we are doing with that 25,800 PE. I'm still looking for 25,780, 25,800 to break with a lot more red cut, possibly a new IS3. I have not seen demand add up near this 25,880 IS30 of yesterday or at the open today. In fact, the D period probe gave me a cut of minus 1,950. So I want to see more supply coming in. So we will hold that 25,900 put, and we'll wait for the market to show its hand over here. We have to be patient because, like I said, supply has taken a hit in the past 2 or 3 days, and they will come back in the market. They should come back in the market. It's just a question of making sure that they have the right time frame to go and execute it as per how they would. So look for IB3s to come in and look for that CEPE Volex cross. The morning was dominated by demand, but we saw evidence of that closing. And look for this purple to come above blue. That would put all your trades parameters in one place, and when that sync happens, the trades are that much more better, right? So I hope, okay, everything is clear and everything is fine. Yeah, we have a working process in place, guys, to understand and every single thing. I'm kind of a little bit disappointed with some conversation over yesterday and day before when I was not in the room. The whole purpose of us working together as a team and as a unit is for you to get better at the business of trading, especially when I'm not there. So you have to put the bigger effort to understand things. The whole idea is to make you independent as a trader, is for you to become good at the business of trading. Understand one thing, that's your role as a trader, to understand and trade for yourself. The whole purpose of us running VLD, doing all this, is for you, okay, to figure out things by yourself, and we are there just to be a path for you to support your decision making. So at no point in time I want all of you to be 100% dependent on what I do or what Uttam does you. That defeats the purpose of what we do out over there. The whole idea is that you invest time in learning, in understanding, in recognizing the tools which are there to become better at the business of trading. So that disappointment stays, and I do hope, okay, the next time I'm not here, I try to be here at all times, but I cannot be there all the time. But I do hope the next time I am not here, you guys can trade much better than how you did in the past 2 days. Right, so I'll switch it back to the order flow charts, and if there's anything else to be added, let's do it over the text chat.